Well, thank you for calling the Alt Funds podcast. This is Skyler Steinke. I'm here today with Brent Kesler. Brent was a chiropractor and chiropractic coach for over 14 years. And after implementing the Money Multiplier Method, Brent paid off $984,000, a little over $984,000, which is pretty amazing, Brent, of third-party debt in 39 months. So we'll get into this the background here, but you also have a passionate belief in what whether you're making $10 an hour or $10,000 an hour, you should know this method and how powerful it is to really enhance what you're doing from a debt perspective and wealth perspective. So, Brett, welcome to the podcast.
Well, thanks, Skyler. Glad to be on, man. Thanks for having me today. I'm excited to share with the viewers.
Absolutely. And this is obviously, this is a unique strategy you want to get into. But let's first start just a little bit with your background and catch us up to where you're at today.
Yeah, well, like you said, I was a chiropractor. I owned 5 clinics in the Kansas City area. Actually, I have not practiced in chiropractic since about 2012. Right? It's just, practicing myself. I sold my last clinic in 2017. My wife and I became empty nesters. We moved from Kansas City down here to Florida. So I currently live in a town called Port Orange, Florida, right next to Daytona Beach, about an hour east of Orlando. Anyway, I was a chiropractor in Kansas City. I went to chiropractic college in St. Louis. I know you're from Omaha, or you're in Omaha, Nebraska, so not too far, kind of from where you were in the Kansas City area. I know we were talking a little bit off air. I have a house in the summer, and I spend my summer. I'll be heading up there in about a month to the Lake of the Ozarks between St. Louis and Kansas City. And I spend my summers up there. I'll be up there till around Halloween time. But so anyway, I was a chiropractor. Well, of course, I still am a chiropractor. I just don't practice anymore. Sold all my clinics. And the concept that I teach now is the infinite banking concept, which we're going to get into a little bit. But it's kind of crazy how I got into this. I was at a chiropractic conference back in 2006. And I heard somebody talk about on stage, they were talking about how to become your own banker, right? How to pay off your debts and recapture, recycle money. And I thought, man, the information I was hearing was really, really good information, but I thought it was too good to be true. I was like, there's no way you can do that. There's got to be a catch, right? So that was back in 2006. So I took in all of that information. Actually, at that conference in 2006, which is now 20 years ago, believe it or not, I can't believe it's been that long. Back in 2006, I actually bought this book called Becoming Your Own Banker at that conference. And a guy that wrote this book is R. Nelson Nash. Now, anyway, so R. Nelson Nash, he became my mentor down the road a little later on. But anyway, I was at that conference. I heard all this information about money and finances, and I thought it was good, but it seemed too good to be true. So I did nothing with the information that I heard in 2006. I bought the book, brought it home, put it on my shelf, went back to my normal chiropractic life, and did nothing at all with the information. So then what happened, Skyler, about 2 years later, in early 2008, I went back to another chiropractic conference, and about 10 or 12 of my colleagues that were at that previous conference are now at this conference again here in 2008 with me. Now, the only difference between them and me is when they heard the information the first time, they acted upon it. They implemented this concept in their life. And I guess they had just assumed that I had also implemented it, but I hadn't. Because anyway, they were coming up to me and they were like, Brent, isn't that banking concept a powerful wealth building tool? Just a tool you can use to pay off your debts, to recapture your money, to get all your overhead from your chiropractic clinics, to build, keep, and create wealth, all with just adding one step in your financial life. In other words, I never had to, right? So the thing is, you never had just to change your cash flow. You didn't have to work any harder, take any additional risk, or lose control, right? So I thought to myself, there has to be something to this method, because there's no way that 8, 10, 12 of my colleagues are lying to me. Maybe 1 or 2, but not, 10 to 12. So I came home and I told my wife, and it was in February of 2008. And I said, honey, I said, we've got to start implementing this financial concept in our life. Now, it was at that time, Skyler, that I was $984,711 in debt. That's what I owed to the third party creditors. Now, I know what you're thinking. You're thinking, well, how do you even know to the dollar how much you were in debt? Well, that was part of the exercise. We had to
Mm,
know that number. And let me just tell you, that is a painful thing to do, to peel back the onion and to look to see exactly how much you owe. But it was just part of what we had to do. So, to make a long story short, I applied this concept into my own life and I paid that debt off, just under $1 million of third party debt, in 39 months, 3 years and 3 months. And
wow.
all I did was added this one step to my financial life. That's it. I didn't work harder. I didn't change my cash flow, take any additional risk, and I never lost control of any of my money. So after doing this, I became really passionate about it, and I started teaching this in March of 2012. Now, my mentor was the guy that wrote this book, R. Nelson Nash. Now, R. Nelson Nash passed away just a little over 7 years ago now. In March of 2019, he passed away at age 87 years old. But let me
Mm,
just tell you, Skyler, this book here completely changed my financial life. I am going to recommend that all of your viewers go out and find this book and buy it and add it to your wealth building library. Wherever you buy books from, just go find it. Becoming Your Own Banker by R. Nelson Nash. It completely changed my financial life. So then I started teaching this in March of 2012, and I became really passionate about it. And I decided,
yeah.
hey, let me sell my chiropractic clinics. So I finally sold the last clinic in 2017. And I've been teaching this concept now for a little over 14 years. I teach it all around the country.
Mhm.
Prior to the last probably year and a half, I was doing 50 to 70 live events a year where I was teaching on stage. I was doing another 100 to 120 Zoom events, podcasts, go
Wow.
to meetings. Um, Now I still do some, I just don't do as many. My daughter is very active in the business, and we have a whole team. My daughter has a podcast called the Money Multiplier podcast, and that's our business, is the Money Multiplier. I have over
Mhm.
17,000 clients that I work with in every state of the country, probably about 140 to 180 new clients every single month that come on board. That's all word of mouth, all referrals. We don't do any marketing, we don't do any advertising. I wrote this book here called Mapping Out the Millionaire Mystery. I wrote this book back in 2019 or 2020, I think it was. I wrote it with a guy named Chris Noggle, who was a client of mine, who is now a colleague. Chris Noggle, possibly a lot of you have heard of him. He's been on a lot of he does a lot in real estate. He's had a couple TV shows, one on House Hunters, one on
Yeah.
HGTV called Risky Builders. So now, yeah, man, that's all we do is we teach people how to build, keep, and create wealth through their own debts and expenses that they already have through a concept, Skylar, that is not new. It's not new. As a matter of fact, I didn't invent it. The guy that wrote the
Yeah.
book, R. Nelson Nash, didn't invent it. It's been around for well over 250 years. So if the thing you can do is go out and do research on the wealthy and the tools that they use to build wealth. So, for example, the Rockefellers, the
Yeah.
Rothschilds, the Morgans, the Stanleys, the Barclays. Go research how Walt Disney started Disneyland, how Ray Kroc funded McDonald's, how Pampered Chef got started before Warren Buffett purchased Pampered Chef. This is the concept that they use. So now that's what we do, is we just
Yeah.
teach this concept to others.
That's awesome. Well, that's really great, Brett. Obviously, very cool background to switch from chiropractic to what you're doing
Yeah.
now. Let's get into the kind of brass tacks of what does this concept look like? How do walk through the steps
Yeah.
on this
Yeah.
strategy from
Yeah.
becoming your own banker?
Exactly. So just to give you the high 25,000 foot overview, and again, if somebody really wants to dive into this and just dive into the nuts and the bolts of the details. Actually, I have a website called themoneymultiplier.com. And on that website, I've got a 90-minute recorded video presentation that breaks it down, all the nuts and the bolts, and it gives you the examples and the case studies and all of that. But today we're going to talk about the high level overview. But the concept
Right.
is the infinite banking concept is about you becoming your own banker in your own life and you taking control of all of your money and all of your wealth. Because Skyler, let's just call it the way that it is. The only time that the viewers have ever lost money is when they've given up control of their money to someone else. This is not about you giving up control at all. As a matter of fact, it's the opposite. It's about you keeping control of your money. Now, the thing that we're going to do is we're going to use this concept to build, keep, and create wealth, to pay off all of our debt, to pay off our expenses, our overhead, to make our investments, whatever that you do with money, we're simply going to add one step to the equation. And what that one step is that we're going to use this process, and the way we use it is it's going to be used, it's going to be magnified by using what we call a whole life insurance policy in a mutual company that pays dividends. Now, guess what just happened there, Skyler? We just lost half of the audience because I used that bad word, life
Whole
insurance.
life.
Because here's what
Right.
people are thinking right now. They're thinking life insurance to build wealth. Why on earth would I ever want to do that? That's a crazy, stupid idea. As a matter of fact, Dave Ramsey and Susie Orman said it would be ridiculous to use whole life insurance to build wealth. Well, let me be clear. This is not any type of whole life insurance policy. No, no, no. This is not the life insurance policy that you can go buy from your brother-in-law that sells life insurance. We all have a brother-in-law that sells life insurance. It is not that type of policy. This is a specifically designed, a specially engineered whole life policy in a mutual company, very important, in a mutual company that is designed for high immediate cash value. One more time, high immediate cash value. So what that means, Skyler, is when you put money into this policy, you immediately, and my definition of immediately, anybody that knows me, is within 30 days. You put money into the policy and immediately, AKA within 30 days, have access to the cash value of that money that you can use for anything that you want, no questions asked. And what we're going to do is we're going to use that money to fund everything that we do in our financial life. And when you do that, when you add that one step, now there is no money that is leaving your family. All of the money now is in a closed system. There's no money being leaked out to other people. You are totally in control of what's going on with that money. And you also, because you are implementing this concept by using this process, remember, the product is life insurance. But the whole concept is not about a product, it's about the process. The process. So the thing you're going to do is recycle and recapture all of the money that goes out to other people. So for example, Skyler, let's just say you're going to go buy a car, okay? Now we've all went out and we bought a car. Now, how do we buy cars? There's only one of three ways that everybody in the sound of my voice right now listening has bought a car. They either paid cash for it, they bank financed it, or they leased it. Okay, unless they stole the car. And I think the audience is probably honest and they didn't steal the car. So here's what you had to do to buy the car. Doesn't matter if you pay cash, bank finance it, or lease it. You have to take the money and you have to give it to the car dealer. So the car dealer gets the money, you get the car, the transaction is over, everybody goes home happy, right? That's the way we're used to buying cars. But when we add this one step into this process, now not only do we get the car, Skyler, but we also get all of the money back for that car. We get the car and the money back. Now, I know that sounds a little crazy and it sounds too good to be true. Remember earlier I said I heard this for the first time in 06, didn't believe it. thought it was too good to be true. Well, I go through in depth the details of how that's done on that presentation on my website on themoneymultiplier.com under Watch Brett Now. But the thing we're going to do is recycle and recapture the money. Now, as I said earlier, the concept is not new, and it is talked about by other people that we all know. As a matter of fact, the guy named Robert Kiyosaki, a lot of your viewers, I'm sure, have heard of Robert Kiyosaki. He's famous for a book called Rich Dad, Poor Dad. He also wrote another book called Second Chance. In that book, Second Chance, Robert Kiyosaki talks about exactly what I teach, recapturing and recycling the money through this method. Another author, Tony Robbins. A lot of people have heard of Tony Robbins. Tony Robbins wrote a book called Money, Master the Game. In
Great book.
chapter 5.4 of that Tony Robbins book, he talks about exactly this concept that I teach. Now, those are both great authors, both great mentors and teachers, right? Good books, good information. But the problem is when they wrote about this subject in those books, they made it too complicated and difficult for the reader to understand. And normally when we read books, we're lazy and we just want to get through the book and we don't peel back the onion to see what the reader what the author is really trying to convey to the reader, and we just bypass it and not even really knowing what it means. So what I've done is I've taken this concept and I've broken it down into a very simple and easy to use method. Now, I want to be clear, okay? I'm not the only one that teaches this method called Becoming Your Own Banker, the infinite banking concept. There's other people you can go out and learn from, but there's nobody on this planet that does more business in this space than we do at the Money Multiplier. Not even close. Nobody does what we do, because what we do is we actually provide you all the tools and all of the material and on an ongoing basis, never a cost to the client at all. We never charge for any of our services for you to implement the concept, because anybody can sell you the whole life policy, but it's about the implementation of it. So we show you how to implement it. Now, yes, I get paid. And how do I get paid? Well, when you buy the life insurance policy, because I'm a life insurance agent in every state of the country, hopefully you're buying it from our agency, the Money Multiplier. You don't have to, but hopefully you're going to buy it from us, because we're are the ones that are going to provide you with all of the resources and tools and ongoing support that goes on year after year after year.
Right. Okay. So that's helpful. So let's maybe step back a little bit on the process. And obviously it's a very unique process. So you shouldn't be doing this yourself, number one, right? You know, working with somebody like yourself that understands this concept. And you're basically funding a whole life mutual dividend paying policy, not for the death benefit, for the cash value. So you're trying to buy the lowest amount of death benefit to get the cash value
Yes.
growing for you. Is that correct?
Yes, exactly right. As a matter of fact, the policy is specifically designed and specially engineered to each individual need. So, like, for example, if you have somebody that's just living paycheck to paycheck, or you have somebody that's a multimillionaire and, basically they are not even spending the interest on their interest. You have two different people at two different ends of the financial spectrum. Now, let me just say, the policy works the same for both of those individuals. It doesn't matter where you're at on the spectrum. It just might mean that the one individual is trying to put as small amount as they can into the policy, where the other one wants to maximize it and get as much as they can inside of it. But you're exactly right. It is a policy that is designed for high immediate cash value. Now, without getting too much into the weeds, what we do is we design the policy with a base premium and a paid up additions rider premium. And there's a blend of both of those. Now, in the beginning stages of the policy, Skyler, your base premium has no cash value. and all the cash is driven by the paid up additions rider. So as far as it would be logical to think that, okay, well, then I want very little base premium and a lot of paid up additions rider because we want to maximize the cash value. And that's the way we design the policy. But however, you have to do it in a way that does not become a taxable event. And you and I talked about this briefly before we started about these policies becoming a MEC, a modified endowment contract. Now, again, a MEC is a term that says if your policy becomes a MEC, it is no longer treated as an insurance contract. It's treated as an investment and it's subject to taxation. Now, prior to 1988, okay, so people were trying to stuff as much money into these policies as they could because they wanted to get these. Okay, the thing they wanted to get all this money into this wealth building vehicle that would grow completely tax free and they could keep dumping more and more money into it. Well, now the vehicle still grows completely tax free, but they limit you on how much you could put into without creating the MEC status. So anyway, just take, for example, this glass here. And let's say this glass holds 10 ounces of water. Well, there's never, ever a way that you're ever going to get 12 ounces of water in this glass. It won't hold it. So what the MEC means is if you try to overfill the policy with cash, it will become a MEC because it won't hold it and it will be taxable. So what we do is we snuggle that policy up to the MEC line with a combination of base premium and paid up additions rider. And that can vary, right? I mean, that can vary from one individual to the next. There's lots of factors that come into that on the policy design. For example, if you put a term rider onto the policy, it allows you to increase that MEC limit. So again, it depends on each person's, financial situation on how the policy is designed. And at the end of the day, it's your choice. It's you, the client. It's your choice on how you want the policy designed. And we show you the pros and the cons of all of the designs. So, but regardless, however it's designed, Skyler, once you get money into the policy, that money is now in a tax-free environment because see, here's what you're doing. The thing that you're doing before you put money into the policy, you are paying tax on that money. So when you pay premium, you're paying it with after-tax dollars. Now, I know a lot of people think, oh, well, that's not good. I don't want to do that. Well, yes, you do. You want to pay tax on your money one time only at the lowest rate possible. And you want to get that money into a tax-free growth rate environment where it's growing forever, tax-free, and the government is completely out of your hair, right? So all the growth is growing tax-free. Whenever we access the money from the policy, we do not do it in the form of a withdrawal. Now, we could withdraw it, but that wouldn't be a very smart way to do it for a lot of different reasons. But what we're going to do is we're going to access the money through a policy loan. Oh, now I know that just turned a lot of people off. Loan? I don't want to borrow my own money. See, that's what people think. They think they're borrowing their own money, but they're not. What you're doing, Skyler, is you have your money inside of the policy, and now you're taking a loan from the general fund of the insurance company, not from your money. You're taking a loan from the general fund of the insurance company, the pool of money, and you're putting your policy up for collateral. So essentially, what you are doing is you are borrowing, Skyler, against your future death benefit. How cool is that? So what we're doing is we are using a portion of our future death benefit while we're living. Instead of you having to buy this stupid life insurance policy and waiting until you die And then all the death benefit goes to your ungrateful children. So we don't have to do that anymore, right? You're borrowing and you're using a portion of that death benefit while you're living. And the loan that you take out never has to be paid back. It never has to be paid back to the insurance company. Now, we teach you to play honest banker and to pay back the policy loan, but you don't have to. But if you don't pay back the policy loan, all that does is it comes off of the death benefit at the end. And I'll give you a real quick example. Let's say hypothetically that you have a policy that has a $1 million death benefit, and you decided to borrow, say, $700,000 out of the policy. Well, now all of a sudden you die, but you did not pay back the $700,000 loan. Well, all that happens, Skyler, is the $1 million death benefit will pay off that $700,000 loan at your death because they already gave you the $700,000 while you were living, and the additional $300,000 will go to your beneficiaries tax-free. So a loan is a prepayment of the death benefit.
Very interesting. So to your point, so what you have in your cash value is never, you're actually not taking a loan against, you are against that, but it's staying in the policy earning interest always.
It is. And that's another cool thing is all the money that you continue to put in the policy, it's all growing at a guaranteed compounded growth tax-free rate plus dividends. Guaranteed growth rate. That's not me telling you, that is in your policy contract. Before you ever buy, pay for, and accept one of these policies, you want to look at the policy contract and you want to look at the two columns. The two main columns is one says guaranteed and the other says non-guaranteed. Now, the guaranteed column can never be less than what it says on the guaranteed side. Now, the non-guaranteed is the same as the guaranteed side, with the exception the non-guaranteed has what your projected policy dividend is going to be year after year. Now, Skyler, so the dividends are never guaranteed, and dividends can be higher than projected and they can be less than projected. And as I said, they're never guaranteed. So the insurance company may not pay you a dividend. It's not guaranteed. But every company that we use to do this has been paying dividends for over 128 consecutive years without fail. So now that's way back into the late 1800s. Now, I want you, ladies and gentlemen, boys and girls, I want you to think about what has been going on in our financial lives since 1897 or 1898, whatever it is. Look at all of the crap and turmoil that we have went through since that time. We've went through the recessions, we've went through wars, we've went through the Great Depression, and the insurance companies have never, ever not paid a dividend during all of that time.
Yeah, if anybody understands risk through long periods of time, it's definitely insurance companies, right?
Absolutely. There's nobody else that does it better than actuaries. The actuaries are the ones that determine that risk. And I mean, it's actually a scary, the thing is, Skyler, it is very scary. What you could do is have an actuary. They can take a pool of, say, 1,000 people in their insured group, and they can tell you how many people are going to die within, say, a year of those 1,000 people. And they will get it pretty much spot on. Now, they don't know who those people are going to be out of that 1,000, but they can basically tell you how many out of that pool will die during that time. It's actually a scary thing to look at. I mean, it will actually just make you sign up for a gym membership and actually go to the gym.
There you go. I'm sure they have some enlightening data to show us there as far as that goes. So can we have a couple of different concepts here? We have, I mean, I'm thinking off the top of my head, an example, borrowing from a 401k, as one concept that people understand. Although in that situation, you're borrowing it and that money's being taken out essentially, and you're paying interest back. But the money is not earning interest for you in that portfolio in that sense. You actually taking money out and just borrowing against it, correct? versus in this case, it's staying in the policy. You're borrowing against the general fund. There's kind of an interest arbitrage situation, I'm assuming, based on what the dividend is paying, the dividend yield is paying on the contract versus what you're having to pay back with the interest rate. Is that correct?
Yeah. So like a couple things on that. Like, and if I don't answer what you're asking, please ask me again. But you mentioned 401k, IRA, qualified
Mhm.
plan. Here's what I tell people. I say, look, I understand the way we've been programmed. Our parents, our grandparents, our friends, our colleagues, our coworkers, they all taught us to do certain things with money. And normally it's like go out and get a good education, get a good job, work for 30, 40, 50 years, and then the government will take care of you and maximize your 401k, your IRA, or qualified plan. Well, let's talk about that. Okay. Is the money in your 401k, IRA, qualified plan guaranteed? No.
No.
There's no, well, actually, there is one guarantee. It's guaranteed to never go below zero. But how exciting would that be if that actually happened? And then the next question is who controls that money? Is it you or somebody else? And then the next question is how old do you have to be to access that money without paying the penalty to access it? Because the tax is always going to be there on the money. And that's age
Right.
59 and a half, right? So I tell
Right.
people all the time, I say, look, don't change what you're doing. I get it that you're used to putting money in your 401k IRA qualified plan. But after you and I start working together, and if okay, if after 6 months that we've been working together and you still think it's a good idea to contribute to your 401k IRA or qualified plan, then you should call me up and fire me. You should terminate me because I did a really piss poor job. You will not ever want to fund your 401k IRA qualified plan again when you have this other vehicle that you can be funding and you can build that wealth tax free. And I'm going to give you a real life scenario. My youngest son is 24 years old. He's a pilot for NetJets. Right, NetJets. They fly
Yep.
around a lot of corporate stars, athletes, things like that. So he's constantly sitting in the cockpit with another pilot. NetJets has an awesome 401k plan. They have a great 401k plan, but my son Zach does not participate in their actually, he participates very, very little because they make him. Imagine that. They make you. They make him
Yeah.
participate up to a certain percentage. But he has this discussion all day long with a new with a new co-pilot, because there's two pilots in the cabin and they're doing is sitting there flying people across the country. I just looked at his location finder before we came on. He's down in Turks and Caicos today. I
Nice.
mean, just on a flight, right? And all they do is they talk about different stuff. And his pilots give him crap all the time. They say, Zach, you're an idiot. You're an idiot, Zach, for not maximizing your 401k IRA qualified plan. Now, Zach tries to explain to him what he does and why he does it, but they
Mhm.
don't get it because they've been programmed to think a certain way. So now Zach just doesn't even have the conversation with him anymore because he's just like, Dad, I've given up. He says they just don't get it. Now, every now and then, a pilot, Zach will just say, look, right. So he'll say to him, he'll say, to him, hey, so I can't explain it all, but if you really want to know what I do, go watch my dad's 90-minute video on the
Yeah.
moneymultiplier.com. And there's actually been a handful of pilots that have called us up and said, hey, I was flying with your son, Zach, and I really want to do this and stop funding my 401k. Now, that doesn't happen a lot, but it has happened a few times over the last 3 years that he's been employed with NetJets.
No, that's pretty interesting. I guess from those conversations, is there a situation where this is not good for somebody? I mean, obviously you probably want consistent income to be able to pay the premiums and
Well,
pay this strategy down, right?
yeah, that's a great
Um,
question. And so here's who it's not good for. If you are the type of person that has to have instant gratification, meaning if you have to be able to access 100% of your money that you put in from day one. So if you put in $1, you have to access the full dollar in day one, this is not good for you. But if you're okay accessing 92 or 93 cents of that dollar in day one, then yes. But it would be the same thing if you went to open up a bank account, right? Let's say, Skyler, if you went down to the local bank in Omaha, Nebraska, and you said, hey, I want to put in $100 into my bank account to open it up. Well, are you going to just turn around 5 minutes later and withdraw $100 out of your bank account? No, you're not going to do
Yeah.
that. You got to keep something in there to keep the account open, right? So if that's you, or if you are not disciplined at all with money, in other words, if you are going to spend more than you make, and in this book, Nelson Nash calls it Parkinson's Law, we have to learn to live off of less than what we have. In other words, I've got a sister-in-law that has not conquered that. For every dollar that she makes, she spends about $1.12. Okay. It's not good for her. It's not good for her because she's constantly in debt, chasing her tail, credit card bills, paying minimum payments, and bankruptcies. And, so my father-in-law had to bail her out a couple of times of credit card debt. So this is not good. This is not good because
Yeah.
they're not disciplined with money. But when it comes down to who can do it based on your financial means, I always say it doesn't make okay. I always say it doesn't matter, Skylar, if you make $10 an hour or $10,000 an hour. Everybody needs to break the bonds of financial slavery they don't even realize they're in, and start taking control of their own wealth and their own money. So, no, this is good for anybody that wants to get ahead or is just looking for another way that's not a conventional way, because this is not conventional thinking at all. As a matter of fact,
Yeah.
if you call your tax advisor, your CPA, your financial planner, your attorney, whatever, and say that you want to put money into a whole life policy, they're going to tell you, well, you sure that's not a very good idea? That's not a very
Yeah.
good thing to invest in. I agree. It is not a good thing to invest in, but this is not an investment. Whole life
Yeah.
insurance designed this way, Skylar, is not an investment. Because, see, Skylar, an investment by definition is something that can make you money and also it can lose you money. That's the definition of investment. In a whole
Hmm.
life policy in a mutual company designed for this concept, you can never ever lose. The value can never ever go down. You have a guaranteed growth rate in the contract. It can never ever go down because, see, the policy, it's not based on fractional. It's not right. It's not like federally regulated. It's state
Yeah.
regulated. Every policy, it's not fractional reserve banking, what we've all heard about. This goes by something called Austrian economics. And if you ever want to learn about Austrian economics, go look at the Mises Institute in Auburn, Alabama, and do a lot of study on money and finance. This has to do with Austrian economics, where $1 has to protect $1. So, for example, a conventional bank, and as you know, conventional banks have went out of business. They have
Yeah.
lost their clients' money because a conventional bank can actually loan $8 to $10 for every dollar they have on hand. If everybody made a run to the conventional bank at the same time to get their money, you would get about 70 cents approximately or less of every dollar that you have in that bank. It's probably way less than that because they physically don't have the money. They physically don't have
Right.
it. When you're dealing with Austrian economics, $1 has to protect $1. So that money has to be there in that insurance contract. And I'll conclude this topic with that, okay, with this. So I want you to go look up. I want you to look up and go Google, go search it. I want you to look up whole life insurance policy in mutual companies, and I want you to look up and see if anybody has ever lost money in a whole life insurance cash value policy in a mutual company. It's never happened. You won't find it. You won't find it. Now, here's the pushback I get on that sometimes. People say, well, what about AIG? AIG
Yeah.
lost money. No, no, no. They did not lose money on the life insurance side, the cash value life insurance side. They lost money on the investment side. The life
Right.
insurance dollars were protected.
They had to pay those out. That's right.
Yes.
Yeah. Well, this is pretty interesting. So if I'm someone in the category of like, I have no debt, everything, I'm looking just to grow what I have. What are some interesting things that people use this for? Okay. So
Yeah.
in concept, they take out a policy with you, they fund the policy, they have the conversation, understand what they need to do up to a certain amount to avoid the next situation. And then what do they do with it? What's some opportunities they can do to grow with it?
Yeah, I'm just going to tell you my own situation and just what I do in my own life. I own like
Yeah.
32. I own 32 of these policies. I put well north of $1 million a year in premium in my policy every year, and I buy at least one new policy every 1 to 2 years. Why do I buy more policies? Because of that MEC limit that we talked about before, because each policy is a contract. So I can't put more money into the contract. So, for example, let's say I'm putting $1,000 a month into a policy, and now I want to put $2,000 a month in. I can't do it. It won't hold it. Remember, only 10-ounce glass won't hold 12 ounces of water. So I have to start another
Another
policy.
one.
Now, in the beginning, when I started this, as I stated, I paid off that debt in 39 months, right? So now I paid off all that debt. And then what did I do? Well, I used the money to fund my overhead in my clinics, to pay the staff, to buy x-ray film, to buy rehab equipment for my clinics. And now I buy real estate. I own short-term rentals, long-term rentals, Airbnbs, VRBOs. I own raw land. I do a lot of lending. I have a big lending portfolio. I lend people money to buy real estate. I lend real estate developers money to build subdivisions, right? So I put
Yeah.
that money first, it goes into the policy. And then from the policy, I take a policy loan and then I lend that money to somebody else that's going to pay me an interest rate of whatever it might be, 12, 14, 16%. So the money is earning money, and it's still earning money because I never took it out of the policy. Remember, I just
Right.
borrowed from the general fund of the insurance company. There's people that invest in oil and gas. There's people that put it into college education for their children. Maybe their children or grandchildren are getting married. Maybe they want to help their kids out to buy a house or buy a car. Whatever it is, it doesn't matter. What we're doing, Skyler, is we are turning every depreciating asset into an appreciating asset. There is no limit to what you can use your policy dollars for. If you want to use the policy dollars to go out and buy a pack of chewing gum at your local Quick Trip, I think they have Quick Trips in Omaha, don't they? I know they have
They
in
certainly
Kansas
do.
City. You can go into Quick Trip and buy a tank of gas.
Yeah.
So as we're doing this podcast at the end of April, what just happened on April 15th? Taxes. Do you know what I did? I took a massive policy loan to pay my taxes. I had to pay my taxes. What do? I take a policy loan. I already knew, I already had an idea of what my tax liability was going to be. So I planned for that in advance. So let's just hypothetically say, for a roundabout number, that my tax liability was $1.2 million. Okay. That I knew that was my tax liability. Now it wasn't, it was way north of that, but I'm going to do easy math. So what
Sure.
does that mean? So that means I should have a policy that has a cash value in it at some point of 1.2 million. So when it comes time on April 15th, I owe 1.2 million, that I am now able to send the government that money. And that's exactly what I did. So now if I know that I had it this year, I know I'm going to have it next year unless my income is going to go down. And it's no fun to
Right.
have your income go down. So I'm not going to have my income go down. So I know next year my liability is going to be at least another 1.2 million. So what do? I constantly am putting in, say, $100,000 a month for the next 12 months, which would equal 1.2 million. And I'm funding that policy. So now the money is there to take care of my tax liability. All while that is happening, I am earning interest and dividends on all of that money. So when I took out a policy loan, Skyler, to pay that tax liability, right? I didn't take my money to pay that. I did not
Yeah.
take my money. I put my policy up for collateral. I essentially took a prepayment of my death benefit to pay that
Yeah.
tax liability.
Yeah.
So, and I'm going to use the money over and over and over again. Now, last thing I'll say is we have a lot of real estate investors. And one guy I'm going to give you is very, very good at this. And he actually is on our team and he helps teaches this. His name is Devin Burr, Burr. He goes on Instagram, TikTok, all the social media by Mr. Burr, MR underscore Burr. It's BRRRR. Now, Devin Burr is a real estate investor in Phoenix, Scottsdale, Arizona. So, what Devin does is he creates many, many videos and he shows you how he buys all of his real estate by using the funds in the policy and he's recapturing and recycling the money. So he's using the same money over and over and over again to buy multiple properties. It's pretty interesting to see. And he's been doing this now for years. Now, one thing about Devin, if you ever talk to him, and I hope you do, Devin was a pain in the ass client when he came to our door. He said, "There's no way you can do this, Brent. There's no way." He says, "There's this thing out there called IUL, Index Universal Life, and that's the best vehicle to use for cash value life insurance." And I said,
Mm.
"Devin, go watch all of our videos comparing whole life to IUL. You would never, ever, ever, ever want to use this concept and use an IUL policy." And now Devin teaches why you should never use an IUL policy. And even Nelson Nash in this book talks about why you never want to use an IUL policy to do this concept. It has to be a whole life policy in a mutual company that pays dividends, that is specifically designed and specially engineered for high immediate cash value.
Okay, this is great, Brett. I know you've written a book, and obviously you have a podcast. Can you tell us where people can find you for
Yeah,
more information?
exactly. Yep. So anyway, the best way is just go to our website, themoneymultiplier.com, www.themoneymultiplier.com. And as I stated earlier, I have a presentation with the downloadable examples and spreadsheets. All you got to do is click on Watch Brent Now. There's lots of things on the website. There's frequently asked questions. And then also my daughter, her name is Hannah Kesler, and she has a podcast called the Money Multiplier podcast. So go out and find that wherever you view your podcast at. And then also the book I wrote, Mapping Out the Millionaire Mystery. You can just send me an email, Brent, BRENT, at themoneymultiplier.com. I will send you the ebook. And then also, I would encourage the viewers. The thing I would say is don't take all the stuff I'm telling you. Don't take my word for it, right? So anyway, there was a mentor that I had. His name was Joel Bauer. And Joel Bauer said, people live vicariously through the words and actions of others. So it's not what I say about myself. I can sit here and tell you how great this product and process is and how great the Money Multiplier and Brent Kesler is. I can sit here and throw up all over you about that. I want you to go Google my name, Brent Kesler with one S. I want you to go out there and Google the Money Multiplier. And I want you to look at the hundreds of testimonials, the plan designs, the case studies, the success stories. And I want you to see what other people are saying about us and this concept. All right. Not necessarily about us. I mean, yes, I hope you will use us if you're going to implement this in your life, because after all, I'm the one that just shared it with you. So I hope you use us and not the guy down the street. So I hope you come to us, okay, for a lot of different reasons. But again, don't take my word for it. Go out and research and see what other people say about us and this concept. And guys, I'm an open book. I am an open book. I will share with you everything that I've done in my financial life, my good choices, my bad choices. I mean, I've got some loans out there. I've got some lending deals out there that aren't performing right now. And I think as we speak
Yeah.
today, it's about $604,000 worth of loans that aren't performing. But that was back when I didn't know what I know now. Now I have over $11.5 million of good performing loans. And I'll give you the key point of what made it bad performing to good performing is I have a t-shirt I sometimes wear, and it says, if you're not first, you're last. If you're not first, you're last. So that means on that bad debt or those I wouldn't call it bad debt yet or bad loans yet, but on those non-performing loans, I wasn't in first position when I did
Mm.
those loans. I will never do that. I'm almost 60 years old now. I will not do loans anymore unless I'm in first position and I have collateral to back that loan. But, it's part of a lesson learned. So, um,
Yeah.
but again,
Yeah.
guys, I'm an open book. I'll share with you everything, the good, the bad, and the ugly. And I actually live, eat, and breathe this stuff. My daughter also lives, eats, and breathes this stuff. This is what our family does. This is what we do. This is how we build, keep, and create wealth, and we keep control of that money. And the cool thing about it is we never take any risk. We don't have to change our cash flow. We don't have
Yeah.
to um, lose control of our money. And every day I wake up in the morning and I stretch and I stretch, and it doesn't matter what happened in the external world. It doesn't matter if the stock market went up or down. It doesn't matter if gold and silver went up or down. It doesn't matter if we have a Republican or a Democrat president. It doesn't matter if we're in these numerous wars. It doesn't matter if there's protests or riots. It doesn't matter if there's a pandemic. Your cash
Yeah.
value consistently, continuously, day after day increases.
That's awesome. Well, this is really, really interesting, Brett. Appreciate you sharing your story in the background, and we'll make sure to include all the contact info in the show notes. This has been great.